Portfolio Construction and Risk Management, Chapter 5, Correlation and Market Relationships. Section 1, Correlation Basics. Correlation tells you how two assets tend to move relative to each other. The key is that we measure it using returns, not raw prices, because we care about whether assets rise and fall together, move in opposite directions, or show little consistent pattern. That makes correlation especially useful when you're thinking about diversification and overall portfolio risk. The correlation scale runs from -1 to +1. A reading of +1 means two assets move perfectly together, 0 means there's no consistent linear relationship, and -1 means they move in exact opposite directions. In real markets, most pairs land somewhere between those extremes, which is why the scale is so helpful for comparison. When you read correlation in markets, you're really asking what forces may be driving different assets. High positive correlation often means they respond to similar economic news, while negative correlation can show up when assets tend to do well in different environments. Near zero suggests a weak linear connection, and that can be valuable if you're trying to build a more diversified portfolio. Correlation is closely related to covariance, but it's much easier to interpret. Covariance tells you whether returns tend to move in the same direction or in opposite directions, but its size depends on the scale and volatility of the assets. Correlation standardizes that relationship into a number between -1 and +1, so comparisons are much cleaner. To calculate correlation, you start with historical returns for both assets over the same dates. Then you find the covariance of those returns, measure each asset's standard deviation, and divide the covariance by those two volatility measures. That standardization is what turns a raw relationship into a comparable correlation number. Once you have the number, interpretation usually happens in ranges rather than with hard cutoffs. Values close to 0, roughly between -0.2 and +0.2, are often treated as weak, while larger positive or negative values suggest more meaningful co-movement. But context matters, because a correlation that seems modest on paper can still matter a lot in a specific portfolio. Let's make that concrete with a simple example. Over a 12-month sample, technology and utilities ETF returns produced a correlation of about -0.04 based on a slightly negative covariance and very different levels of volatility. In plain English, those monthly moves didn't show much consistent linear relationship. A near zero correlation can matter because it suggests two assets may not move in lockstep. That can help reduce concentration inside a portfolio and improve diversification. But it's only a historical clue, since relationships can shift and sometimes tighten during market stress. It's also important to remember that correlation is not causation. Two assets may move together because they both respond to the same macro forces, like interest rates, inflation, or investor sentiment. And even a strong relationship can be temporary or partly coincidental, so correlation should be treated as evidence, not proof. Correlation is useful, but it has real limits. Too little data, a different time period, or changing market regimes can all produce very different results, and a single number can miss nonlinear relationships entirely. That's why investors usually pair correlation with rolling analysis, stress testing, and other risk measures instead of relying on it alone. To practice, take the 5 days of prices for stock A and stock B and first convert them into 4 daily returns. From there, calculate the covariance, find each stock's standard deviation, and use those pieces to compute the correlation and decide whether it looks negative, near zero, or positive. Then ask one more question. Why might such a small historical sample fail to predict what happens next?